now. It's February 25th. We are in Chapter 5, review session. And I'm just sharing my screen. I want to bring up a really helpful slide and that's in your textbook. Really helpful page, I should say, in your textbook. Okay. So can you guys see my, those of you that are here, can you see my textbook?
Yes.
Appendix
Yes.
5. Okay, thank you. Appendix 5A. So this next exam, which will be next Wednesday, a week from tomorrow, we will be covering Chapter 4, which has 7 journal entries on adjustments, but I say 7, but there's more within each category. So for example, you could have a journal entry for insurance expense, prepaid insurance. You could have a very similar journal entry, rent expense, prepaid rent, something like that. But the 7 basic journal entries and slight variations to those. Chapter 4 also has closing journal entries. So that's 4. So that's 11 journal entries by my count. So now let's look at the textbook. Chapter 5, you've learned, in main part of Chapter 5, you've learned the perpetual inventory system. And now in this appendix, you're learning the periodic inventory system. So there is a very helpful sheet here. And if I were you, I'd print this out and use it for my studies. So we have 1, 2, 3, 4, 5, 6, 7 different transactions in Chapter 5. And they all deal with, hang on, they all deal with inventory, either purchasing inventory or selling inventory. So these first 4 transactions are about purchasing inventory. The last 3 have to do with selling inventory. All right. And then, I'm sorry, mine is all highlighted. I was trying to figure out how to unhighlight them. Apparently that's not an option, but so I was trying to say, could you trash it? Could you hit it again? Nope, doesn't work. So bear with me on the highlighting, folks. No, it doesn't want to do it. Okay. So in this first column here, it's how you make those 7 journal entries using the perpetual inventory system. In the second column, there's how you make those same journal entries using a periodic inventory system. So 7 journal entries for perpetual, 7 journal entries for periodic. You need to know how to do both, and you need to know when to use each system. So when you're going through your homework problems, your first question needs to be, what system am I using, perpetual or periodic? But this is 14 journal entries. So in Chapter 4, you have 7 adjusting journal entries, 4 closing journal entries. In Chapter 5 and 5A, the appendix, we have another 14. So that's 25 journal entries to learn. We also need to understand the statements related to inventory companies, the multi-step income statement. And we also need to learn how to calculate cost of goods sold. Okay, so that's where we're headed in this chapter. And I wanted to open it up. Hugo, if you have specific homework questions, correct?
Sorry, yes, but I feel that anything you're about to teach us will help me with that. So nothing that targeted.
Okay, that's fine. All right. Hi, Akiko. All right, so let's, no, we're not going to do chapter 10. You guys are not learning about bonds and time value of money. Don't save. All right. So let's pull that up. So what would be most helpful to all of you? Put it in the chat. Do you want to review the journal entries? Do you want to review anything specific in chapter 5? So go ahead and post in the chat. We should go over the homework. No, that's your job to go over the homework.
Okay.
Yeah. I mean, it's pretty low points. So, I mean, you can do the practice reviewing the journal entries. Yeah. So, all right, let's take a look. Yeah, so up till now, we have been really looking at service companies, all right? And we did that deliberately because when you sell inventory, Akiko, I can hear you.
I'm sorry.
It's okay. But let me know if you have a question. All right. So we have a lot of companies out there that are merchandise companies. And so what that means is they have inventory. Companies like Target, companies like and companies like T&T and Factoria, I don't have that one, but Nordstrom, grocery store, department store, that kind of thing. So what we want to be able to do is, oops, I didn't want that. Which one do you see? Do you see the right one? That's the question. Okay. All right. So we have a lot of companies that are merchandise companies, and that introduces two new accounts this chapter. Cost of goods sold, which is a special expense account. So it goes under the expense category. We've got assets, liabilities, stockholders' equity, revenue, and expenses. Cost of goods sold is an expense, and it shows up on the income statement. Inventory is an asset. It's a future value. So companies buy a lot of inventory, they put it out in their stores, and then they sell it. Or they're like a middle person, where they buy a lot of inventory, put it in their warehouse, and sell it to stores. But at any rate, they're holding the inventory. Okay. And then understanding all the costs that it takes to go into inventory. Okay. Let's see, share. Which screen am I sharing? I don't want to share that screen. I like this screen better. Okay, let's do that. Share. Okay. All right. So merchandise companies buy and sell goods. Goods is another word for inventory. We have a new account for revenue, and that's called sales. So we're going to use that now, or you can also call it sales revenue. Okay. Inventory cost, and we abbreviate cost of goods sold as COGS. I know that doesn't look like an account title, but it is because it's so long and wordy. All right. So here's on the right side, you see your old style income statement. We put service revenue in the top. We listed all the individual expenses. We calculated net income before tax. We calculated income tax and so forth, and down to final bottom line net income. But with a merchandise company, and that means companies that buy and sell inventory, we have a new account here, cost of goods sold, and we're going to add a new subtotal, gross margin. We're going to add another subtotal. No, we're not adding anything here. This is another subtotal, income before tax. That's the same on both, and income tax is the same on both. Okay. All right. And it gets a little more complicated too, and we'll get into the multi-step income statement. All right. So what do we use for cost of inventory? Do you guys have any questions on how we calculate the cost of inventory? Or do you want to move on to the journal entries? There's the image. So this is what we'll be working with in this chapter. So, all right. So this new title here, gross margin, sometimes, I think this textbook sometimes calls it gross profit. It means the same thing, okay? It's just a calculation, sales, total sales minus cost of goods sold. All right. Do you guys have any questions on how we cost inventory? So the rule is it's all the costs it takes to get the inventory ready to be sold. In this case, the language is more general. It's all the costs to get the asset ready for its intended purpose. What is inventory's intended purpose? To be sold. Okay. So we have the original price. It's like buying a car. If you've ever bought a car, oh, that's just the sticker price. We also have freighting and transportation. We also have sales tax and so forth. Well, we don't have sales tax on inventory because reselling it, we don't have. If you're a reseller, you're not charged sales tax. Only the final customer is charged sales tax. But we have other things, purchase discounts. If we get a discount from the seller, And then if we send some of the inventory back. Okay. So we're going to look at journal entries for perpetual. Okay. Oh, dang, I did it again. All right. Sorry, guys. All right. Can you see my screen?
Yes.
All right. Thank you. All right. So journal entries for perpetual. So we have 2 sets, 4 for purchases and 3 for sales. Okay. So it's something to keep in mind. And the book uses merchandise inventory, and I'm not sure how widely the homework does as well. But on the exam, you can use merchandise inventory or inventory, but just be consistent. Don't switch back and forth. All right. So when a company buys inventory, inventory goes up. Inventory is an asset, so that means we debit it. When a company pays the freight bill to bring the inventory in, it increases the cost of inventory, so we debit inventory. When a company returns inventory, we reduce the inventory account. That's a credit. And when a company gets a discount, we reduce inventory with a credit. And finally, now that we have the inventory, when we sell the inventory, we reduce the inventory account, and that's a credit to inventory, but cost of goods sold increases. We've increased our costs. And once in a while, we count the inventory to make sure it's there. And some of you may have been part of counting inventory if you've had jobs that worked with inventory. Okay. So here is the seller. Here is the buyer. The buyer is buying 20 graphing calculators and 25 little calculators for a total of $1,400. So that's the first journal entry, number 1 of 7. The buyer is saying, I want to put this inventory onto my balance sheet for $1,400. Debit inventory, credit accounts payable. How do I know it's not cash? Because the terms are 210 net 30. In other words, 2% discount if you pay in 10 days. Otherwise, pay 100% in 30 days. Any questions about those terms? Is cost of goods sold an expense? Yes, it is. All right. So debit inventory, credit accounts payable. And the terms 210 net 30. Oh, sorry. Let's go back to the invoice. We have the shipping terms, FOB shipping point. So what the heck does that mean? If you've already taken business law, you know this, or you'd be familiar with this. FOB shipping point is the most common. That means ownership, or also called title, ownership transfers at the shipping point. And that is why the buyer pays the freight bill, because the buyer owns it from that point. If the terms were FOB destination, the seller would pay the freight bill, and ownership would transfer when the goods arrive at the buyer's store or warehouse. Now, like I said, FOB shipping point is most popular. All right. FOB shipping point. So let's assume the freight bill is $140. Now, freight bills are different. They have to be paid really fast in 10 days. So we will use the cash account, not accounts payable. Freight bills do not come from the seller. They come from the shipper. So this company would get a freight bill from the UPS company. Debit inventory, credit cash. Why do we debit inventory? Because we can't get the inventory without paying that freight bill. So it increases the cost of the inventory. All right. Now, if the terms were not FOB shipping point, if the seller paid the freight, then the buyer wouldn't book any entry for the $140, and the seller would book this entry, freight out and cash. Freight out is an expense. Why doesn't it say freight out expense? I don't know. It's just practice. All right. So purchase returns and allowances. This is when the buyer gets the inventory and decides to send some back. They can return it for credit. So they ship the inventory back, they return it. Or the seller may say, don't return it, we'll just give you a credit. And that's a purchase allowance. But we book them all to the same account. So in my example, I'm saying the buyer, Jennifer, returns 2 calculators to Judith's calculators. And they have to give you the cost of that. So here it is, 2 calculators, 65 each, debit accounts payable, credit, merchandise inventory. Now that's just a reversal of that purchase transaction. If we go back and look at that one, oops. Here's the purchase transaction. So we're saying we returned it, so we're reversing it, debit AP for the returns. Here we go. Debit accounts payable, credit inventory. Now, I'm going to strongly encourage you all in your homework and in your exam to make little T accounts for accounts payable and inventory so you can keep track of all this. Okay, so I don't know. Can you see my board? I don't know. Let's see if you can. So I would do I don't know if you can see that. I think I'll do it on Excel. Let's go switch to Excel. All right, here we go. That's good. Let's do. I'm going to set up 2 T accounts, and you do it too if you have access to a pencil and paper. And one's going to be inventory, and one's going to be accounts payable. Okay. Okay. All right, so let's share that screen with you. All right, I'm sharing my Excel screen now. Hopefully you guys can see it. I've got inventory and I've got accounts payable. So let's go book those journal entries. Our first journal entry was debit inventory 1400. Yeah, you guys can see that. And credit accounts payable 1400. And now we've paid the freight bill. And I'm not going to track the cash accounts, but I could. Let's do this. $140. I could do that, but I don't really care about tracking cash. I really want to keep track of inventory and accounts payable. I'm not trying to do a full accounting cycle. I'm trying to see what the ultimate cost of my inventory is and how much I ultimately owe my my supplier. Okay, so let's go back to the PowerPoint real quick. Okay, here we go. So we had the freight bill, and now we're going to book that return of $130. So we're going to share that screen back to my T accounts. So I'm returning. I'm going to debit accounts payable of $130 and credit inventory. I'm reducing inventory. Okay. Now it's time to pay the bill. And that's why I like the T accounts. I want to keep track of all this. So if you remember back on our invoice, the terms were 210 net 30. And let's go back and look at dates here because the dates are going to be really important. So our first journal entry was 2/4/14. Our freight bill was paid February 13th. Our return was February 13th. Okay. So we've only like 9 days have passed. Now our invoice terms were 210 net 30. I get the buyer gets a 2% discount if they pay within 10 days. Otherwise, they have to pay the full bill in 30. There are other terms you can look up in your textbook, but this is the one we're going to use today. So we look at accounts payable and we say, how much do we owe? So going back to here. So I'm going to take the difference. You guys can see my spreadsheet, yes?
Yes.
Thank you. Thank you, Eric. All right. So I'm going to calculate my balance. And I know we have lots of other activity in accounts payable, but I'm just focusing on this one transaction of the calculators. So I originally owed, the buyer originally owed 1,400. The buyer returned 130. So the buyer owes 1,270 right now. Okay. So when a seller gives you a discount, I'll give you 2% discount if you pay in 10 days. You should only be taking it off of the net amount, net of returns. You shouldn't be taking the 2% on the 1,400. Should be taking it on the 1,270. Okay. So we're going to calculate a 2% discount on the 1,270. So I'm just going to do it down here. 2% times 1,270 is $25. I guess I could show that screen. So I'm going to do it down here. 2% times 1,270 is 25.40. Please just round. So if it's 50 cents, go up. 50 cents or more, go up. If it's less, go down. So round that number to $25. So if I pay this, if the buyer pays this invoice within 10 days, they get a $25 discount. Now, 2% earned on 10 days works out to like 36% benefit per year. So you should, if you have the cash, you should always take the fast payment discounts. Okay. All right. So we've calculated this. Okay. So we're going to say we owe 1,270. So we're going to clear the 1,270. We still have 1,270 in accounts payable. We have a credit balance, so we're going to debit it to clear it out. But that $25 lowered the cost of our inventory. So we're going to credit inventory 25. And then the cash we actually pay our supplier is $12.45. Okay. So let's post that. Oh, we got a question. Just confirming you would want us to round up the discount. Yes, please, Eric. Yes, 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 yes. Thank you for asking. Okay. So let's post this last journal entry. So now we're going to say 1,270. And this new balance is going to be plus 1,400 minus 130 minus 1,270. So that invoice doesn't owe any more money. And then our merchandise inventory is, again, the cost of it is going to be reduced by $25. Okay, so let's go back and look at that journal entry again. Okay. Debit accounts payable, we've paid the bill, we've cleared it out. We owe that, we don't owe any money on that invoice. We've reduced the cost of our inventory $25 with that purchase discount. And of course, we paid less than full value. We paid 98% of what we owed. Okay. All right. If you didn't have the money in 10 days, maybe you were waiting on a client to pay you and you had to wait the full 30 days, you would just debit accounts payable, credit cash, the way you've already learned how to do in chapter 3. Okay. Please take discounts when you can. Okay. So looking at the balance in our inventory, so we had the purchase transaction, the freight in, less the return, less the discount. That inventory cost us $13.85. So that's pretty good. All right. So those are the 4 purchase journal entries. Okay. So I'm going to put one in the chat. Maybe we could do a practice one. And you guys could direct message me these transactions. Let's go back. I want sales, I want purchases. You want to read about fraud. All right, here we go. Can you see this?
Yes.
Okay. On September 5th, buys merchandise on account. The purchase price of goods is 15. The cost was 800. On September 8th, La Jolla returned. Record the transactions. So give me the purchase transaction and then give me the return transaction. Direct message me in the chat, please. I have one journal entry so far, and it's incorrect. Eric, you are correct. So, anybody else? Kendra, you are correct. Kendra, John, wrong transaction. Doing the one in where it says do it. Anybody else? Bhavik, you are correct. Oh, wait. Akiko, you have the wrong amount for the first journal entry. Okay, let's talk about the journal entries. So on September 5th, let me do this. See if I can squeeze this up. So we're just doing inside this gray box. And we're saying La Jolla buys merchandise. You guys can see the screen. On account from Juno Diaz Company. The purchase price is $1,500 paid by de La Jolla. The cost to Diaz is $800. On September 8th, they returned goods $200. And so this is exactly the tricky part of these journal entries. You've got the seller, you've got the buyer. You need to know what system you're using. They don't tell you, but it's right after the perpetual. A normal test question would tell you they use perpetual. So whose books are we doing? Are we doing Diaz or La Jolla? We are doing record the transactions for La Jolla, de La Jolla. Okay, so that's what we want. All right. So some of you are doing merchandise inventory. I'm just going to do inventory. And then I'm going to do accounts payable here. And let's get the date in there. The date is September 5th, okay? And then we want to do the balance. How much money are we spending? It's 1,500. Okay. It's not 800. That's what it cost Diaz. So remember the rule in business, buy low, sell high. So Diaz bought it for 800, but De La Hoya is buying it for 1,500. Okay. Now the next journal entry is September 8th. And just like, and some of you already have this, accounts payable. And then we're going to do inventory. So you see, you're just reversing these transactions. But, you know, of course, the dollar amount is different. So how much did they return? They returned 200. Okay. All right. Now, Eric is asking, what about Diaz? Well, we haven't done sales yet. We will get back to Diaz, I promise. Okay. So let's go back to, let's do sales now so we can finish this problem from the other point of view. Okay. So here we are going to look at sales. Learn the journal entries for sales. So now we're going to do the books from the seller's point of view. All right. So we knew from this, no, we don't know. Okay. You know what they sold it for. And this, so now when you are a business that makes sales of merchandise, your simple sales transaction, which used to be debit AR, debit accounts receivable, credit service revenue, 2-line journal entry. Now it's a 4-line journal entry. So debit accounts receivable, credit sales. We're not using service revenue. It's sales because it's inventory. If you prefer, you can call it sales revenue, but you don't have to. Then we debit cost of goods sold and credit inventory. We're increasing our costs and we're reducing our inventory. Now they have to tell you what this dollar amount is. This is how I worded it on this slide. Assume COGS is 75% of sales. Okay. It could also say, assume gross margin is 25% of sales. Remember back on that earlier slide, sales minus cost of goods sold equals gross margin or gross profit. It means the same thing. Gross profit means the same thing. Okay. So when they give you, sometimes they'll just give you the dollar amount. Cost of goods sold, 1,050. Sometimes they'll say cost of goods sold is 75% of sales. Sometimes they'll say gross margin is 25% of sales. You've got to calculate, that means cost of goods sold is 75%. So here's your journal entry for sales. And I'm going to get through these 3 and then we'll come back to that problem. So again, in this chapter, we did purchase returns and allowances. Now we're doing sales returns and allowances. So it all depends on perspective. So for this exam, I tell students, bring a couple of highlighters. When you get these problems, write in small print, buyer is Jennifer, seller is Judith, and that will focus you on, are we doing purchase transactions or are we doing sales transactions? It'll get very natural to you shortly, but it's really, you got to be careful and make sure you identify which role goes where, because it changes whether it's a buying transaction or the selling transaction. And you will see in my PowerPoints, you will see in your homework, you will see on the exam, one set of prompts. Do the buying transactions, do the selling transactions. So you have to know them both. All right. So sales returns and allowances is a contra revenue account. Okay. So up here, you had sales. That was your new account, new revenue account for when a company sells inventory. Here is your contra revenue account. It's a debit because it's reducing sales. Sales is a credit, sales returns is a debit. So We could just debit sales if we had very few returns, but most companies like to separately track. And remember, all these accounts are so that companies can separately track things so that they know how their business is doing. So companies like Target, they want to know what their returns are. They want to know what their returns are by department to see which departments have more returns or which store has more returns. Maybe they have a quality control issue with a certain product. So it's real important. So we debit sales returns and allowances for the returns, and we reduce accounts receivable. Customer doesn't owe us this money anymore. But we also have to bring the inventory back if the inventory is returned. So debit inventory, credit cost of goods sold. So this journal entry is almost a mirror image of this journal entry, except we use a new sales returns and allowances. Okay. All right. So there's that. I'm going to do one more and then we'll go over to these others. Finally, we have to record when the customer pays us, and we have to recognize the sales discount, that 2% that we gave them. All right. So again, this is a mirror image of what we booked on the purchase side. The seller brings in $12.45 of cash. They clear out their entire accounts receivable, and they recognize that discount, debit to sales discount. So that also reduces sales. So think about it. We made sales of 1,400. We had a return of 130. That lowered our sales. We had a return of 25. That lowered our sales again. Okay. Okay. So let's stop there. Let's go back to our problem here. And in the chat, I want you to record now, it's not asking you for the sales transaction, but I'm going to ask you for the sales transaction. So I want you to book the sale on September 5th. I want you to do it for Diaz books. So book the journal entries. I'm going to call it JEs for the sale and the return on Diaz books. Okay, so take a minute and do that. You'll have to read the problem, Bubby. They have to give that to you in the problem. You can't assume it. Can you see it? Okay. You are correct. Can you do the return journal entry, John? Anybody else? Oh, you're right, Bubby. It did not tell you for the second half. You have to guess. But you almost perfect, Bubby, on the second. You have one account wrong. So let's do this for the return. Shall we assume a price of something? Let's see. That's it for the return. really good. That looks really good, Eric. That's correct. Okay, let's give it a heart. Okay. Kendra, that looks great. Okay, so anybody else? Um, all right, let's put the solutions here. So we are now doing DN books. So we'll do September 5th, and this is going to be the selling transaction, and it's going to be accounts receivable. It's going to be sales. It's going to be cost of goods sold. It's going to be inventory. Can't spell today, but that's okay. All right. So accounts receivable and sales will have the same number. Cost of goods sold and inventory will have the same dollar amount. So our sales price was 1,500. And our cost was 800. Okay. Now we have the return to book. Now make sure, so you're going to see this is almost a mirror image of what we just did, but we're not going to debit sales. So make sure you debit sales returns and allowances. Okay. Our return was 200. Oh, hang on. Sales return and allowances and accounts receivable. Maybe 200 and 200. And I've got about 2 more minutes, so we're just finishing up perpetuals. So, and then it's going to be inventory. And we're going to So I said use 55%. So we'll make that a calculation. Oh, 55 times 200, and that'll be 110. Okay. So be careful that you make the twins, to put the twins together. Accounts receivable and sales, same number. Cost of goods sold and inventory, second twin, same number. And that works the same for the returns. Now I know this is a 4-line journal entry. We haven't done that before, but this is an exception to what I have told you in the past, which is list all the debits first and then list all the credits. For merchandise inventory, sales, transactions, and returns, I want you to list them in their twin pairing. Accounts receivable, sales, cost of goods sold, inventory. Okay, it's not wrong if you do it the other way, but this is the accepted pattern. Okay. All right, let's go back here. And did I book a sale? We don't know if they paid for the inventory. Yeah, we haven't booked that yet, but we didn't have that prompt yet. Okay. All right, my time is just about up. Is there anything super urgent that you guys have questions on?
I have a specific question to me. I don't know if it applies to anyone else though.
Go ahead.
I'm wondering for the critique we just did on the other team's project, the first prompt, it said 100-word essay. I was like at 250 words. Is that okay? Or should I just like shorten it? Should I edit it to try to be like,
And you shorten it because if you multiply that by 33 students, it's a lot of reading. So we try
yeah,
to be as succinct as we can.
okay. Yeah, for the second question, I was in between the 100, 150. For that first question, what would you ideally like? Would you like me to be at 100?
Sure, that'd be great. Yeah, you don't need to go real long. The most important part is the last question on what people can do to improve all of that. So,
Okay, so, sounds good. I'll shorten that up.
okay. All right, so there's a lot more to this chapter that we have here. Let's make sure I want, okay, just making sure. So these dates are wrong. Will be Tuesday, March. Oh, 4th, yeah. No, it's gonna have to be Monday, March 3rd at 1:30. We are school, there's no school on Tuesday. Gonna have to change that. Okay, I will videotape that. Okay. Exam will be next week, March 5. 1:30 p.m. I changed it this year, but same room. All right. Okay. That's for next week, so we won't worry about that. Okay. Alrighty, I will see you guys later.
Excuse me, I have one more question.
Sure.
Sorry, we have another project too. It's started. I mean, we have to do first submission is due in this Friday. It's this Friday.
Let's take a look. It is due this Friday, so let's take a quick look at that. All right. I was thinking something, it's the status report that's due later. Okay. Oh. So you guys have already done a project plan for project 1. So you're gonna go into project 2. And that's where you're gonna do the financial analysis. So, and this project, I would download this and your contract page will be on here as well. So you'll see, get your statements by Thursday, and there's a very easy step-by-step on this, and I'll show you that. Make your contract project plan, and then your paper will be due in a bit. We're not going to do a status report on this, okay? So the contract should be fairly straightforward. Assign a team chair, get your financial statements, make sure I approve your financial statements because sometimes there's errors. And then here's the layout of the project. So essentially this project, you're not doing any research on this project beyond a financial statement. Okay, so you just do a brief introduction of the companies and then you'll do a bunch of calculations. You'll gather income statement information, net sales, cost of goods sold, and so forth. You'll make some calculations for the current year, whether that's 23 or 24, the prior year, and then a third year back. You'll do it for your other company, and then you'll do the balance sheet information, okay? Then you'll write about it. And the writing is not meant to be a 16-page paper. You're answering basic questions. What was the sales trend? What's the net income and gross profit trend? And discussing your ratios, and then make an overall conclusion. And then you'll do that for income statement. You'll do that for balance sheet. And then just like you did with your business models, you'll say which company is best. So for this week, you need to get together with your team, pick somebody to go find the statements, one person, upload one set of statements per company, and then you need to assign your work by Friday. Okay, so let's do this. Let's go look at units and modules. So company projects. So if you're the person assigned to find the statements, I have a little video on how to access the statements, and then there's that project again for your reference. But here's how to access your statements. It's very step-by-step on how to find your statement, okay? And there's a little short video on that. So find your statements, get your contract in, and find your statements this week. And then we'll focus on studying for the exam for next week, and then we'll be working on our paper, okay? Thanks for asking that, Akiko.
Thank you.
Okay, guys, I got to go to another meeting.
Sorry for that. Thank
No,
you.
no, I'm glad you asked. I'm really glad you asked. So,
Thank you.
all right, you guys take care. Bye-bye.